Sweet spot mortgage terms in 2025 predictions from the Globe and Mail. I want to talk about interest rates today because apparently, according to an article written on July 22nd, the Globe and Mail is predicting that mortgage rates today range from bad to horrible, but there's a sweet spot. Curious to know what that is. They go on to say the cheapest mortgage rates today are for a fixed term of 5 years. I don't know about you, but I would have loved to have locked in for 5 years. I knew that this was going to happen. You can't print all that money and give all these gobs and billions of dollars out for free. Taxpayers have to pay that. We managed to lock in for 3 years. That was the max that we could go at the time. And unfortunately, I would have gone for 5 because that would have put me at renewal for 2026, which would have been amazing. Unfortunately, though, I'm renewing next year. Back to the article. Cheapest mortgage rates today are for a fixed term of 5 years. But as they say, who wants to lock in for 5 years right now when rates are thought to be peaking? So, question, I'm curious, do you think rates are peaking right now, or do you think that they're going to go up? 1 year mortgages make sense strategically because renewing in 12 months could let you tap into those lower rates. But the premium you'll pay for having that opportunity is huge, the article says. Is there a sweet spot compromise between the two? They go on further to say why some mortgage renewal payments could rise into 2025, even with rates projected to drop. Desjardins models currently forecast an increase in variable rate payments for people renewing in 2025 to 2026, writes Robert McLister in his weekly column at the Globe and Mail. The figure is based on the expectations that the Bank of Canada will drop interest rates by 2.75% percentage points by 2025. I would be delighted if that happened. We locked in at 2.89. I would be happy to stay within this same payment structure because let's face it, we all purchase properties based on what we can afford to make our payment be, based on employment, based on how many people are contributing to the mortgage. They do the stress tests. They factor in the extra variables, supposedly for all of this sort of thing to happen. But I don't necessarily think that people were prepared for the interest rates to go up on the level that they did, as extraordinarily fast as what they did. Article goes on to say, but why are variable rate payments set to increase so much if interest rates are projected to drop? Great question. The reason is that many payment hikes could be a result of borrowers paying off less principal to keep payments fixed in today's high interest climate. Exactly what I just said. We base purchasing a property on what we can afford monthly and yearly. That is the premise of what the bank will tell us or the mortgage broker based on what we are allowed to borrow. So they go on to offer what the lowest interest or mortgage rates are available. I'm not going to get into that. Basically, they're saying Canada's leading nationally advertised rates barely moved in the last week, which is obviously a welcome development after the average Canadian mortgage rate surged 74 basis points in the last 2 months. Is Canada's approach to housing bad for our productivity? I'm curious to your thoughts on that one. This is in the article. Canada's poor labor productivity is in the news these days, but there are a few better places to start than with the country's approach to housing. When housing is a great investment, it can be a symptom of a sick economy, he writes. Additionally, everything from commute times to traffic or public transit has an impact on it. So, just as an aside to that, Canada's GDP relies heavily on housing. During COVID, everybody invested in real estate, contributed to the bubble that we're in. Obviously, we have to pay back all of the money that was printed and handed out to people that were ill-deserving of it. I did recently read an article that 15-year-olds were collecting CERB. I don't know about you, but I'm not sure what 15-year-olds have bills that need to be paid that they should be collecting CERB checks. So obviously that's contributed to all of this. You can't continue to print money as a country and not pay for it or think that there is no fallout associated to it. So Canadians chose to take that extra money that they had, because a lot of them did have it, and they bought real estate with it. They bought secondary or tertiary properties, they bought investment properties. They did the right thing, in my opinion. If you have extra money and you don't want to see it go to waste, especially if the buy in was good, you buy a safe investment. So in Canada, I'm just going to throw this out there, say real estate is somewhat like a blue chip investment. It's a buy and hold, it's a long term strategy, it is not a short term growth strategy, and it's safe. Canadians are known for being safe and apathetic in nature, and that's what we do. So, curious as to your thoughts on what the Globe and Mail is predicting for interest rates. I know for myself, as I indicated before, when we purchased our home, we locked in our mortgage for as long as we could. I also advised my clients, not as clients, but as a friend, as an aside from everything that I've seen in the real estate industry over the lifespan of my career, to lock in your rates. A lot of them did, some of them didn't. The ones that didn't, their payments went up exponentially, and consequently, they're paying the price on that now. So I did choose to lock in my rate. We managed to lock in for 3 years max, because it was basically my partner and I coming together again, and I hadn't owned a home for a while. Switching jobs, etc. Obviously, these are all stress test factors. So we locked in for 3 years. We're renewing in 2024. I am very closely paying attention to what is happening in the mortgage industry, because obviously that affects everything that we do going forward. And I know for myself, I was always, for all of my investment years in real estate, I always played the variable game. This was the first time that I had ever locked in a mortgage for the max time. But I wanted a secure payment. I knew that the interest rates were going to go up, not expecting them to go up to the extent that they did. So I locked in for a safe strategy. I know going forward, I again will pay close attention to this. And for myself, I will more than likely predict, my prediction right now is that, as I said before, I truly believe that miraculously the interest rates will start to go down as we're going into an election year. Because if you look back on history, this typically is what happens. And I will probably ride a variable for a year or lock in for 1 year, depending on what the payments will be. Bite the bullet on that one. I know that right now the prediction is that, we're going to have to pay a little bit in order to jump forward and then lock in at a later rate. Also decide whether or not we want to sell the house, because these are things that people don't think of quite often. Is if you are planning on selling a house, don't lock into a fixed rate where you'll be penalized for the buyout. Get a variable. Talk to your mortgage broker on that. A lot of people don't think this through. If you think you're moving, don't lock in your mortgage. You want an open mortgage so you won't be penalized when you move. Add all these factors in. Anyhow, those are my thoughts for today. I'm curious to see what your thoughts are regarding this with mortgage rates, where we are in Canada, what your prediction is, what you think rates will drop to. Please comment below. Be nice. It's been great. I have been loving the exchanges and the participation that everybody has contributed to all of my rants, I guess. They're not really podcasts yet, but I'm going to be starting that fairly soon. So I love keeping you informed, and I hope it helps. Ciao for now. Peace out. Love y'all. Bye.